Welcome back, everyone, to Money and Markets. Smart investors know it's important to get several perspectives on any stocks or industries that you're considering buying into. So for our final segment, we brought in two experts who see the retail sector from different vantage points. Rudy Martin is here on set. He, of course, is an emerging market specialist at Weiss Research. And coming in through Skype from Irvine, California, is Andre Julian, Chief Financial Officer and Senior Market Strategist at OpVest Wealth Management. Thank you so much to both of you for joining us. Andre, I want to start with you. What is your overall view right now of the retail industry?
I think right now, if you look at the retail numbers, they came out relatively strong today. Even if you exclude auto sales, you still had about a 0.4% increase. So it's not anything that's lighting the world on fire. But it is showing improvement. It is showing that consumers are actually spending a bit more than they have been in the past. I think you had a 6% year-over-year increase in retail sales. So we're slowly coming out of this sluggish economy. But again, it's still anemic. And I think over the next two months, it's going to be very important to see how these numbers continue on. If you look at Monday's report, you'll see that there are a lot of nuances, especially when it comes to strength in the auto sales versus your regular retail sales. So I think that retail sales, for them to continue to be strong over the next 2 months, will show a nice rise in GDP going into next year.
Rudy, do you agree? Are we climbing out of the valley here?
Well, I'm fundamentally positive on both the consumer and retail sales. And when you think of auto sales globally, you think of China, which is the largest emerging market at this point. And in China, GM is selling about 20% more cars in October than it did in the prior year. So things are really looking good for them in that market. In the U.S. market and developed countries, it's not so positive. They have only about a 3.5% increase in sales overall. And fortunately, that is improving somewhat. But a lot of the improvement in the U.S. market has to do with what the financial stimulus is from the cash for clunker programs, the quantitative easing too, and so that's had its course. And now, as you look forward, we're going to have to see some other things to push it forward.
Now, Rudy, a lot of experts say a good place to park your money, especially this time of year, is with places like Walmart and Target. You disagree with that. Why is that?
Well, if you look at the past performance of the discount retailers, something like the dollar stores, you'll see that the discounters, they've done very well. But a lot of that has to do with the fact that people were very concerned about the economy. Now, with the government coming in and basically providing a backstop to the economy, I think you need to look at companies that have more of a growth dynamic to it. And I've been talking for a while now about inflation globally, and it appears in the agricultural sector, and it's starting to appear on a spot basis in different products and services. And I think you need to start preparing yourself in your retail investing strategy as well for that. And I think I have some names in that market that might do well too.
Okay, we'll get to that in just a moment. Andre, your take on what Rudy said? You don't particularly agree with everything, right?
Yeah, I don't agree with everything. I mean, again, we're all looking at the same picture, but I think that people are picking out different details. Obviously, the emerging markets have been really strong, and I think that inflation is on the rise. Because if you look out over the next couple of years with the sinking dollar based on QE2, it's just going to basically mean a rise in prices. If you look at the retail numbers of the past 3 months, I think they've really been impacted by the ags. I think they really have been impacted by the autos. And if you really take a global picture, there is value you can find. So where I disagree with Rudy is looking at these high-end retailers, because if you look at the high-end retailers, a lot of them have PEs of 62. I know that 20, 30, 40 PEs, I mean, where are they going to go? Where is the growth? And they've really moved. So the reason people are looking at discounters is because they're trying to find value, that they have money that they need to spend over the holidays, and then obviously over their consumer discretionaries are going to be the ones that suffer, because again, when people spend money, they're going to be very conscious and they're going to be budget conscious. So again, half of the coin, I agree with Rudy, half of the coin, I see pressure coming in those high-end retailers and in the discretionaries.
Okay, Rudy, you mentioned a list of names. Give them to me.
Well, I have 3 of them. The first one is a company, Saks, ticker symbol SKS. And that one has really great brand name that everyone's familiar with. It has an internet outlet that's doing double-digit growth. And one of the things that's really important is that they're less dependent on promotional efforts to get growth up versus others. I also like the fact that it's selling at an attractive discount relative to some of the other players. If you look at the book valuations, I'd rather get something like a Saks at 1.7 times value than a Kohl at 2 times value. I don't see a discount value there, so I like that one, SKS. In the supermarket area, I haven't traditionally been very positive about supermarket companies, but I do note that the Whole Foods market has about 14% increase in cash flow, well above the norm of 8% for its peers. It has really great turnover of inventory, solid capitalization. This is a company with not just a brand, but a real franchise in the market, and I think they'll do well. They've got about 45% appreciation year to date, and I continue to think that that will be a premium stock going forward. And my last one is something that comes in a little blue box. For some people may know that one. That's the Tiffany, ticker symbol TIF. Here's a company that's only 50% U.S., the rest is international. It has a great brand. It's taking that brand abroad into places like China. I expect the Chinese stores count to double, triple over the next couple of years. So I'm looking at a company that has not just a brand, international focus, and the ability to market, but some real potential going forward.
Andre, which individual retailers would you recommend to your clients?
You know what? You have two very divergent opinions between myself and Rudy, because we're actually staying away from Saks because of the PE is so high, and from Tiffany's because you have such a strong PE. But again, that's what makes this market, and that's what's superb about it. I think that you'd look into Lowe's. Lowe's is a great company. They've actually been lagging behind Home Depot. Home Depot has actually started to show some strength. I know that the housing market isn't back yet, but I think over the next few years it will be, especially with what's going on in the emerging markets and the rest of the global growth continuum. So take a look at Lowe's, because it's a laggard. So I think that's a very good value right now. I like Sears Holdings a lot. Sears Holdings is basically Sears and Kmart. If you look at Eddie Lampert, he's a brilliant investor, and he's taking control of that. They're trading well below book. If you look at that company, it actually has a net worth of about $15 billion with 110 million outstanding shares. If you divide those two numbers, doing simple math, you look at a share price that should be around $135 a share. It's well below that. It's trading at about half of that. So it's a huge discount right now. And I like Walmart. Walmart is a good discounter. They have an international presence. They have a national presence. They're doing very well. And as consumers are clearly seeking that discount and seeking value, I think that's a place to go as well.
Okay, flip side of that coin, still to you, Andre. What areas should retailers, investors, should they stay away from in the retail industry?
I think consumer discretionaries. I think the discretionaries, and in the service sector right now, the service sector is weak, the discretionary sector is weak. And until we see more of a pickup in the economy, those sectors are going to remain weak. And again, that's why I don't like the high-end retailers either, because it's just money really, I don't think is going to flow there from the consumer end, because money seeks value. And right now it's seeking value in different areas.
Rudy, a sector or a
I
name?
definitely disagree, Andre. And what I'd like to say is, I love Lowe's. It's a great company, but I also follow a company called Masco, and they do the Behr paints, and they just posted sales that were 2% lower. And if people aren't painting their houses, then you've got a situation where they're just not investing in that home improvement area. So I'd stay away from that area. That's my count on that.
Okay. Rudy, I want the final word to go to you. Any macro trends across the industry that you're seeing that are going to have an impact that the consumer may not even be aware of?
Well, definitely. I've been talking about inflation in emerging markets for a while now. I've been talking about how it's affecting hard commodity prices, soft commodity prices, how it's coming in and affecting the suppliers. And what I see in the U.S. is I see the situation where companies with pricing power, strong brand recognition, and the ability to control costs are going to make a real difference and provide some value for investors.
And Andre, back to you. Macro trends that you see?
Yeah, I mean, if you look at the macro trend as far as China and the emerging nations, I think that's where a lot of our GDP growth is actually going to come from. You see, GDP, we know that the consumer accounts for about 3/4 of that GDP, but I think that a lot of it's going to start being substituted by orders from China, by orders from India. So I think that as long as our dollar remains about where it is and our exports are strong, that's where you're going to see a lot of strength over the next year.
All right, Andre Julien, Rudy Martin, thank you for your disagreements.
Okay, thank you.
Also, thank you to Jen Amos, Nilas Mativ, Amber Dakar, and Dr. William Strong. That does it for this edition of Money and Markets. Next week, we'll revisit a topic that anyone buying supplies for Thanksgiving dinner knows all too well: Food prices are on the rise. In fact, soft commodities of all kinds are enjoying an extended bull market. We'll tell you why and how investors can take advantage of it. As always, if you have any questions for this week's guests or suggestions for topics that you'd like us to cover, just email us at weissmoneynetwork@weissinc.com. I'm Jamie Holmes, and now, Martin Weiss.
Okay, Jamie. 2/3 of the U.S. economy is driven by consumer spending. But what drives 90% of consumer spending? I have the answer for you: consumer credit. In fact, from the end of World War II until the debt crisis, the U.S. economy had been consistently fueled not just by consumer spending, but more specifically by consumer borrowing. For over 62 years, American households were on a non-stop binge of borrowing and spending, and then borrowing more and spending still more. Let me explain it this way. In every single year, from 1946 through 2008, consumers always took on more debt. There was never a decline in the consumer's overall debt load, not once. Washington and Main Street were delighted, of course. The more that consumers borrowed, the more they spent. And the more they spent, the bigger the revenues for the nation's retailers, and the bigger the tax revenues flowing into Uncle Sam's coffers. Then, something extremely unusual happened. American households not only borrowed less, they also cut back on prior borrowings. Some of them cut back because they defaulted. Some cut back voluntarily to restore their finances and to avoid default. But either way, the result is absolutely earth-shattering. The Federal Reserve reports that in 2009, consumer debt outstanding was slashed to the tune of $115 billion. And it didn't stop there. In the first half of this year, that trend has continued. And if you think the decline in consumer spending is shocking, wait till you see the decline in another related category of debt: mortgages. In 2009, the total mortgages outstanding in the United States plummeted by $300 billion. And the first half of 2010, mortgages are being slashed, gutted, at the annual rate of about $550 billion. And I repeat, this is not just a decline in new consumer credit or new mortgages. This is a decline in debts outstanding, something that has never happened since records have been kept. Now, the $64,000 question is this a good thing or is this a bad thing? Well, the answer should be obvious. If too much debt was a major cause of the debt crisis, then it stands to reason that less debt is one of the best solutions. But Mr. Bernanke and Wall Street don't seem to see it that way, nor does the retail industry. They know that less borrowing by consumers means less spending by consumers. They know that less spending means lower sales, reduced profits, and a sharp decline in tax revenues for the guys in Washington. So they're going to do everything in their power to get consumers to borrow and spend like they used to. My take? They may be able to fool some consumers some of the time and even get some of them back into the stores for this holiday season, but they won't be able to lure most consumers into a new debt trap for many years to come. I'm Martin Weiss for Money and Markets.